Okay, so Stephen, walk us through this.
Yeah, so I'll just kind of take us through here with the definition or how a trigger rate is actually calculated, right? And Tyler did a good job explaining of when that point happens. So how that's actually calculated is pretty simple, and it's in this example here. So you take the payment amount, multiply it by the number of payments per year, and then you divide that by the balance owing, and that shows you essentially at what time will your payment just cover the interest costs of that mortgage, and that is essentially the trigger rate. Okay.
Hold on, Stephen, just to be clear here. So you're talking about scenario one. If you could use your mouse here, then you can actually help us.
Yeah, for sure.
There you go. Yeah, that'll help us. Yeah. Just so we can follow on the screen. Go ahead.
Awesome. Yeah. So that was just the trigger rate there. And then it essentially gives you the rate in a percentage term. So for scenario one, I broke it down into two scenarios, and this is kind of, very illustrative of what we've seen in the last 6 months or so in terms of rates and where rates potentially will be going in the next couple of weeks here with the pending increase by the Bank of Canada again. So I'll kind of break it down here. So original principal balance we've used for argument's sake of 600,000 as of January of this past January. The original rate at that time, I've used prime -1, which at that particular point in time would have been 1.7%. The amortization period of 30 years, the payment amount biweekly, given that information above of $1,063.52. And as of today's date, approximately the current balance owing will be $591.80. So plugging those figures into this formula here, that gives us a trigger rate of 4.67%. Okay, so that is the rate at which, if the rates increase higher, anything above that, if their variable rate exceeds that, the payment amount will be reset as per their original contractual amortization period, given the current rate environment. So what does that look like moving forward? So I'm just going to scoot over to scenario 2 here, just to show you that it is important to note that as you decrease your amortization period, so the shorter amortization periods of mortgages, let's say they took a 25 or a 20 year, the less likely that client is going to be to hit a trigger rate, and therefore they're less likely they will to have their payments increased. And that's just based on the science behind a blended payment amortization schedule, in that, the shorter the amortization period, the more of your payment goes towards principal right off the hop, as opposed to a 30-year mortgage, right? So in this case here, just for argument's sake, the trigger rate you can see is substantially higher by, 80 basis points or so. So what happens in scenario 1? And this scenario 1 is indicative of a lot of clients that I've seen over the last 6 months, especially with the housing market exploding over the last 18 months, given COVID. More and more clients are taking a 30-year. And if you're in a 30-year fixed payment VRM, this may be similar to your situation. So what happens if the Bank of Canada increases rates by another % in September, which all signs are pointing to somewhere in that range? What does that do? So this client's payment now becomes prime -1. So 5.7 minus 1 is 4.7%. Pretty simple math there. What does that do? So now their new payments are set based on that 4.7%, based on a 30-year am, to keep them on their contractual original amortization period. The new payment amount becomes $1,521.93 biweekly. The increase in payments become approximately $458.41 biweekly, and that amounts to a 43% increase in the client's biweekly payments. So you can see from this diagram here that a trigger point for some clients will be a shock to the system. And to Amanda's point, there are ways that we can mitigate this, and there are ways that we can coach our clients into avoiding this type of situation. But back to Amanda and to Tyler's point, it is important that we are having these conversations with clients, or for clients to reach out to us, to make sure that they're in a situation where they feel most comfortable in. And if it comes to a point where that trigger point is reached and they're unaware of it, as you can imagine, a 43% increase in your payments on a biweekly basis, may wreak havoc on someone's budget.
Yeah, because they've been used to paying $1,063 because they were essentially in a fixed payment this whole time. Now the rate's gone up to 4.7, which is just higher, just above their trigger rate of 467. And so now all in one shot, they're getting hit with the payment increase rather than a gradual increase in a variable rate, like the traditional variable rate with a variable payment. That's what we're saying, right?
That's exactly it in a nutshell. You got it.